Okay, the second part of the class. Here we have unearned or deferred revenues. Um, so what is an unearned revenue? You receive cash in advance, and then after some time you provide the service or the product, and it is recorded as a liability until the product or service have not been delivered. Um, then when the products or services are provided, they become earned. The adjustments to be done are we increase the revenue after the revenue is earned, and we decrease the unearned revenue, the liability item. Example is for example, the famous Economist, The Economist magazine collected $25 million from subscriptions for 1 year on December 1st, 2012. What kind of adjustments are required for the annual financial statements prepared on December 31st, 2012? So it's like all other magazines and newspapers, they receive the subscription payments in advance, and for the Economist magazine, that $25 million is an unearned revenue. So each month, a portion of that $25 million is recognized as earned revenues. So for example, for at the end of December 31st, 2012, so after 1 month, the company recognized 25 divided by 12 portion of that money as earned, and that amount is decreased from $25 million, which is an unearned revenue liability. Accrued expenses are expenses, costs that are incurred in a given accounting period but are both unpaid and unrecorded. Examples are accrued salaries, accrued interest expense, accrued rent, accrued taxes, accrued wages. Accrued salaries expense example, fast forward, its employee earns $70 per day or $350 for a 5-day work week beginning on Monday and ending on Friday. The employee is paid every 2 weeks on Friday. On December 12th and 26th, wages are paid. When the business is closed on December 31st, she has earned 3 days salary but not paid. So because the salary is paid on the 26th, and because of this weekend, she only has 3 days not paid, and this cost is not recorded. What should be the adjustment? So for 3 days, she should receive 3 multiplied by 70, $210. So the adjustment is $210 salary or wage, accrued wage, accrued salary, liability, and an expense, $210. Okay, so salaries expense of $210, you can see here, recognized, right? And salaries payable of $210, a liability item, and that's what the adjustment we need to make. So 700 for the for the first 2 weeks, I guess, and $210 for 3 days that were not paid. So salaries expense debited and salaries payable liability credited. Interest expense works the same way, or others. Okay. Accrued revenues are revenues that are earned in a period that are both unrecorded and not yet received in cash. Commissions, fees, interest revenues are received at the end of the period. They are recorded at the end of the accounting period. One example is Fast Forward agreed to provide 30 days of consulting service to a local Fitness Club for a fixed fee of $2,700. The terms of the initial agreement call for Fast Forward to provide service from December 12th, 2011 through January 10th, 2012, or 30 days of service. The club agrees to pay Fast Forward $2,700 on January 10th, 2012 when the service period is complete. If Fast Forward prepares financial statements on December 31st, what adjustments should be made? So we can see the answers here. $1,200, $1,800 of that dollar is unearned, that is accounts receivable, and and consulting revenue, which is credited. Revenues are credited, expenses are debited. So this is the adjustment that needs to be made. Okay, so in summary, we have seen 4 different types of adjustments that need to be made to the trial balance that we have prepared, and you can see these 4 categories here and the effects on the balance sheet and income statement before adjusting, and the adjusting entries to be made. Okay. And after we make the adjustments, the trial balance, that trial balance is called adjusted trial balance. Before this class, we prepared unadjusted trial balance, and after making the necessary adjustments, we prepared the adjusted trial balance. And from that, this is an example of an adjusted trial balance. So you can see the unadjusted trial balance, first 2 columns here, and then you make necessary adjustments, and after that you will have the adjusted trial balance. And adjusted trial balance is the place where we make our final financial statements. So basically, revenues and expense balances are used to prepare the income statement, profit and loss account, and net income and withdrawals are used to prepare the statement of owner's equity, and asset and liability balance are used to prepare the balance sheet. So 3 financial statements. Of course, there is the 4th financial statement, cash flow statement, which is prepared from not from the trial balance, but it is prepared from the income statement and the balance sheets. Okay. So there are some questions and the answers that you look through to understand what we've been discussing so far. So I can just, I think, go over one of these. So there is an imaginary company called Hammond Company. The ledger shows on March 31st, 2012. It includes these selected accounts before adjusting entries are prepared. So we have a prepaid insurance of $3,600, supplies of $2,800, equipment of $25,000, accumulated depreciation on that equipment of $5,000, unearned service revenue of $9,200. So first of all, let me go. Prepaid insurance, it's the insurance. For insurance you pay in advance for a certain period of time. Supplies are like things that are used in this company. It can be, I don't know, notebooks, paper, pens, pencils, or whatever this company uses. Equipment, you understand it. Depreciation is the loss of value of non-current assets. Accumulated means the depreciation amount is added every year and they accumulate over time. Unearned service revenue, so you got paid in advance but you have not yet provided the service. Okay. So an analysis of the accounts shows the following. Insurance expires at the rate of $100 per month. So you pay So apparently you pay for 3 years in advance, and each month you use $100 of that payment. So supplies on hand total $800. So you used $2,800 minus $2,000 of that during this period. And the equipment depreciates $200 a month, so it loses $200 of its value because of use every month. 1/2 of the unearned service revenue was earned in March, so $9,200 divided by 2, $4,600 was earned. So you provided the service. Now you have the right for that revenue. So the question is, prepare the adjusting entries for the month of March, and these are the solutions. So first, insurance expense, that's $100 insurance expense recognized for that month, and prepaid insurance, that is the asset account credited, which means that you decrease that by $100. Supplies expense, $2,000 used, and supplies asset decreased by $2,000. Depreciation expense recognized $200 for that month, and accumulated depreciation equipment, which is which decreases the asset, is $200 here. And unearned service revenue, which was $4,600. That is by how much you decrease that liability, and you recognize $4,600 of revenue for that month. And there is another similar exercise. You'll go over these, and that's it. I will give you 2 similar exercises for you as homework. You will have to prepare and upload to a website. I'll send you more information about that. Thanks.